You will own SpaceX stock whether you want to or not. If you have money in a QQQ ETF, a target date fund, or a 401k with any Nasdaq 100 exposure, that's already happening automatically about 2 weeks after IPO day. SpaceX is getting fast tracked into the Nasdaq 100, and every fund that tracks that index has to buy. Fund managers have no discretion and no choice. So the real question isn't whether you own it. It's whether you own the right amount at the right moment with a thesis you can actually hold. I'm Co. I've been investing since 2007 and spent the last 2 decades inside startups, big tech, and my own businesses. The one thing that separates work optional investors from everyone else is knowing when patience is the actual play. Today, we're getting into the 3-layer bet buried inside SpaceX's S1, the structural dynamic that changes everything for long-term holders, and the specific signals I'm watching before I put a single dollar in. Before we go any further, nothing in this video is investment advice. I'm not your financial advisor. This is how I think about my own portfolio, and you should always do your own research. SpaceX is not one company. It's 3 businesses with 3 very different trajectories, all wrapped inside one stock. Which one you think you're buying determines everything. Layer 1 is Starlink, and this is the business you're actually buying. In 2025, Starlink brought in $11.4 billion in revenue and generated $4.4 billion in operating income. That's a 39% operating margin. Most tech companies spend years chasing profitability. Starlink got there at scale and is now accelerating. Revenue grew 50% year over year. Operating income grew 120%. I've used Starlink personally on flights, and the difference is night and day. In-flight Wi-Fi used to be the running joke of business travel. You'd pay $15 to barely load an email at 30,000 feet. Now, I can be on video calls from a plane, no buffering, no dropouts. That's a real product with real lock-in and a real market that's barely tapped. The total addressable market for Starlink is everyone on Earth who needs reliable internet and doesn't have it yet. That's 1 billion plus people, and Starlink is building toward them while generating the cash to fund it. If Starlink were its own public company, it would be one of the most compelling growth and profitability stories available right now. That's what you're actually getting a piece of when you buy SpaceX. Layer 2 is the space division, specifically Starship. The space segment lost $657 million from operations in 2025, and that's intentional. Starship is the next generation, fully reusable rocket that, if it works at scale, collapses the cost of getting to orbit. Right now, building and launching satellites is expensive. Full reusability changes that math. SpaceX could eventually build and maintain Starlink's constellation for a fraction of today's cost. That's the thesis, and it plays out over years, not quarters. Layer 2 is a long-duration bet with real potential and real costs on a timeline that requires patience. Layer 3 gets interesting and very expensive. SpaceX's AI division brought in $3.2 billion in revenue in 2025 and lost $6.36 billion from operations. That's a net operating hole of more than $3 billion in a single year, on top of the revenues it generated. In first quarter of 2026, the AI division did $818 million in revenue against a $2.47 billion operating loss. The pace isn't slowing. Every dollar Starlink generates is being fed into this machine. The bet is that AI compute costs eventually come down and revenues scale. That's a legitimate thesis, but it's not a short-term play. And right now, it's the biggest variable in SpaceX's financials by a long margin. You're not buying one company. You're buying Starlink's cash flow, a decade-long infrastructure bet, and a wild card that's currently the most expensive line item on the income statement. Know what you're actually signing up for. Here's the structural dynamic most investors are sleeping on, and it matters whether you decide to buy or not. 15 days after the IPO, SpaceX gets added to the Nasdaq 100. Nasdaq changed its own rules to make it happen. Every investor with QQQ, QQQM, or any target date fund tied to the Nasdaq 100 will automatically hold SpaceX. Fund managers who track that index have to buy, on a schedule, whether the business has reported anything yet or not. That's mandatory, algorithmic, price-insensitive buying arriving roughly 2 weeks after the IPO. Beyond that, there's active discussion about S&P 500 inclusion. That would trigger a second wave, bigger and slower, touching every passive index investor in America and abroad. Both effects are real and additive. They create demand that has nothing to do with the business itself. But mechanical buying tells you nothing about whether the company is executing. The lockup schedule is where patience becomes an actual advantage. The S1 discloses two separate tracks. Track 1 covers company insiders, directors, and executive officers, a 180-day lockup from the IPO. After 6 months, their shares are eligible to sell. Track 2 covers Musk and significant investors, and it's a 366-day lockup. That's a full year with no early release provisions. He cannot sell a single share for 12 months, regardless of what the price does. The 180-day mark is the first real test. When insider shares become eligible to trade, you finally see what the actual sellers want to do. That's historically when the real information about an IPO arrives, not on day one, but after the people closest to the business can finally act on what they know. Look at Circle as a recent reference point. It IPO'd at $31, traded heavily on momentum and a constrained float. And then, trading behavior changed materially as the lockup windows approached. The company didn't change. The business didn't change. The supply picture did. And the information embedded in that trading changed with it. That's the pattern every major IPO goes through. Heavy momentum on restricted supply, then a different kind of price discovery once the people closest to the business can act. The second phase is where you actually learn what you're holding. So, what am I actually watching? 3 milestones. First is the 180-day lockup expiration. When insider shares become eligible, watch the volume and behavior in that window. If insiders hold, that's information. If they unload, that's different information. Either way, you learn something real about how the people closest to the business read it. Second is the first quarterly earnings report as a public company. Right now, SpaceX reports behind closed doors. The first time management stands on a public earnings call and takes analyst questions, you see how they communicate, what guidance looks like, and how they handle scrutiny. That's your first real read on what kind of public company this is. Third is the AI burn rate. If AI operating losses start to narrow, whether from cost reduction or revenue scaling, or both, that changes the consolidated picture meaningfully. If they keep widening at this pace, that's a signal about how long Starlink is going to be carrying the whole operation. None of these have exact dates yet, but the 180-day lockup has a known timeline. The first earnings call follows from it. The AI trajectory will show up in every subsequent report. There are 3 risks I'm actually watching, and none of them are the obvious ones. The AI burn rate isn't just a growth investment. It's a structural drag on a company that isn't profitable at the consolidated level. If that doesn't improve, this becomes a sustained cash question, not a temporary one. Regulatory concentration is real. Starlink is approaching dominant positioning in satellite internet in several markets. Telecom infrastructure at that scale attracts regulatory attention. We're talking pricing pressure, usage restrictions, mandated competition. These aren't hypotheticals in a different policy environment. And Musk concentration is embedded in this stock in a way no shareholder controls. His focus, his public standing, his decision across multiple businesses, all of that comes with the ticker. That's been true for Tesla, and it will be true here. It's not a reason to stay away. It's a reason to be precise about how much of your portfolio is riding on one person's trajectory. SpaceX is unlike anything that's gone public before. Starlink is a real business. It's growing fast, generating margin, and serving a market measured in billions of people who don't yet have what it offers. The space and AI divisions are expensive, decade-long bets that may pay off in ways that are hard to model right now. The index mechanics create structural buying that has nothing to do with fundamentals. The lockup schedule gives patient investors a specific calendar of information arrivals to work with. The market sees a high-profile IPO. The work optional investor sees a sequence of signals: the first earnings call, the 180-day lockup, the AI trajectory. That gap between hype and signal is where patient investors do their best work. My plan is to wait, read the first quarterly report, watch the 180-day mark, and make the call on real information instead of day one noise. If you want the full framework I use for evaluating high-profile IPO entries, that's linked in the description. And one more thing, there's a section of this S1 I haven't touched. It's the part where SpaceX tells the SEC what they actually think they're building. And the number they filed makes Starlink's revenue look like a warm-up. That's in a future video. So I'll see you in the next one.